Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Hey, greetings. Thank you so much for joining us to Macro to Micro Options Power Hour. We're gonna hit it after the holidays, after taking a week off. And by the way, happy holidays. And Hans, happy holidays. Hope you had a good Canadian version of an American Thanksgiving, because you couldn't trade on that day. And you were actually thinking, oh, we're gone. So you had a shortened trading week, whether you liked it or not, but you've been crushing it on a lot of your option plays that you've discussed with clients. And so we come together and basically want to review market direction, sector rotations, select stock choices that we really like, the options that support it, and then answer your questions. So you can hit us up in Zoom Q&A, particular interest, that we can give to your particular trade idea, but please let us know the time frame. One thing that I like to do is kind of break it down into chase, swing, trend time frame. Everyone defines that differently, but definitely chases for the momentum. Swing can last a few weeks to a few months, and trends are obviously more durable, sometimes macro or sometimes very specific trend trades within stocks that are just working because of a theme or because you really like the company fundamentals, and they can take months to years. So just let us know your time frame. And in case I didn't do a proper introduction, I'm Samantha LaDuc, founder of LaDucTrading.com, and joined by Hans Albrecht. I'm on the East Coast of the US. He's in Toronto, Canada. So we kind of envelop the whole thing here from macro to micro as well. Hans is our options mentor. So he works not only in teaching options, how to do it the right way, both for alpha and for hedging strategies on your portfolio, those overlay strategies, earnings plays and the rest. But he also works with our clients and delivers a lot of custom trade support. So we have an hour to kind of go through our particular view. And we have 2 weeks that since we've done this. So we're pretty much trying to bring this year home. And to that end, we actually were frustrated Monday, Tuesday, a little molasses-like market. But today it kind of unstuck. My growth to value rotation triggered. And we saw a whole bunch of stuff pushing higher. So that's working in the tech space. Hans, why don't you give us a lay of the land, especially as it relates to volatility and the fact that we don't really have any right now, as it is supporting your very bullish backdrop as well. In fact, I don't think you have any shorts, do you?
I don't. I put on a little short, Samantha. Good afternoon, by the way. Great to be back. I put on a little target short today. It's kind of bounced after those terrible earnings. It's bounced up into that 130 level. And I thought, boy, I'm kind of long a lot of stuff right now. And I've been telling students and clients that this is an interesting market in that there's a lot of FOMO going on, right? We're seeing, you and I have talked about the parabolas all over the place. A lot of stocks just kind of pointing straight up. Even formerly, boring kinds of stocks are just kind of taken off. And so the temptation is, of course, to just kind of start going, oh, that looks good, and that looks good, and boy, that one looks good too. Before you know it, you've got like 29 different positions on, and maybe not realizing that in the end, because of correlation, well, they're all kind of doing the same thing, right? I mean, of course, there are individual stories and there's narratives that we talk about, and great storylines, but everything is kind of following one big narrative, which is risk on, right? It is game on out there, and the dips don't last very long, and that's kind of typical of a VIX sort of 12, 13 environment. I tweeted this out today. I said, those dips that you get where the stock starts to come down and you go, oh my goodness, if this has a little bit of follow through, I'm going to get a chance to buy my favorite stock at a reasonably good price, and it turns right back around and goes right back up again. And you get that kind of sinking feeling that, oh, there is another opportunity missed. And that is very, very typical of this sort of 12, 13 environment. So what I try to help clients and students with is to kind of reframe how they look at things. When you get, we had sort of, it wasn't a super volatile environment going into the election. It was more like a high VIX environment with not a whole lot going on. But now you have a combination of stocks pushing higher with very low levels of volatility. So that takes a little bit of a different approach. You have to be a little bit more careful. The premiums get a little bit thinner, a little leaner around the market.
Yeah, just as an example of that, oh goodness, late September, mid-October, I can't remember, no, beginning of October, we did a webinar on that NVIDIA financed call spread, right? And at the time, it was 136, it was not 136, but it was like 130, 132, whatever. And the point was, we just hit 132, 136 last week. That 115 put was $8. It's now $2. So the IV crush has really come out of these instruments, and it's a little bit more challenging to kind of get a good structure like that, because post-election, post-earnings, it's almost worthy of swinging for the fences, which I hate doing, but to buy that right tail risk of higher calls. So let's dig into that. Keep going, but yeah, I see what you're saying.
That's a big trade. You're right. That trade is still very valid, and some of the big vol watchers have talked about how that right tail continues to be relatively cheap. Now, I'm a little surprised at the strength we saw today. We've kind of pushed, I've been calling for this move towards that collar, that sort of 60-50, 60-55 level, which seemed like this massive magnet. We went through that in September, end of September, where we stuck around that 57-50 level, and it really kind of put the clamp on markets, right? When we talk about positive gamma, that just means there's a lot of stock on either side, and eventually it keeps trading till that range just gets so narrow that it feels like nothing's happening. And so I kind of thought we'd sort of push up into this level and maybe have a little bit of resistance, but boy, after a little pullback earlier in the day, we just pushed really to the highs of the day. So what that starts to do for me, this isn't my base case, but what it starts to do is potentially have us start to look at 61.25, 61 to 61.25 as an area where there isn't that much gamma anymore. And when there's no gamma, and in fact, potentially negative gamma, what that means to the viewers is that you could end up with almost a bit of an air pocket. So this isn't my sort of base case, because I think we saw one of the lowest volumes, I think, yesterday in years.
Yes.
It was
5 years.
crazy though.
5 years.
5 years. I mean, so maybe we can chalk it up to, okay, everybody's gone home, and so there's a little bit of that low liquidity sort of drift up happening, but that almost makes it more amazing, because there's very heavy stock for sale in theory right around here, and a low volume rally like this almost shouldn't have the success it's having, but it is. So there's this incredible underlying strength. And I dare to say that if we kind of get to that 61.25, 61.50 level, we could have a kind of a melt up. I call it sort of the kind of melt up that would even make Tom Lee blush, like a real kind of like, whoa, what is happening here? We are just literally the market has gone parabolic. So for bulls, I think it's been good times. Maybe it gets a little bit better. For bears, I think you just have to be a little bit careful here, because there's an old saying, you don't really want to short a dull market. And this is going from dull to kind of a little bit on the, extra extreme bullish side here over the last day or so. So I wouldn't get too crazy getting in the way of this. I'd like to see a little bit of confirmation, maybe have a day down, and then reestablish the fact that there's this large gamma, there's a bunch of stock for sale in theory up here. And then I'd start feeling a little bit better, not about a big crash. I think we're kind of due for maybe a 75-point drop, but I think you can start putting on almost like daily iron condors to play a little bit more of a reasonable range. We've talked about that before. When stocks go parabolic, you kind of just want to step aside and wait until you get that 1 or 2 down days. And then that kind of resets the idea that, okay, there is a top. Now we can start to trade within a little range again. If we see another day like this, I'm not seeing any kind of top. We're making new tops every day. So it's hard to get bearish when you keep making new highs.
Let's talk about this chart that I threw up here, which is Charlie McElligott from Nomura. And then I overlapped one quote that he had kind of to apply in this aggregate dealer gamma out 6 months, looking at that right tail where we're grinding higher, and once above that JP Morgan collar of 60-55, dealers could start to chase that tail. And one of the things that I pulled out was, but if we zoom up to SPX plus 2%, like today we're on NASDAQ, a nice little hit, but only 0.62 for SPY. We're 1.23% on Qs, but specifically is referring to SPX. We can then see negative gamma. This is potentially a feed to that spot up, vol up. So that would be the tell that we could get more eruptive in that parabola that you're talking about. Right now, we've not traded above a 2% up or down in SPX for quite a while. So this, except for the election results on that Wednesday, which was the Trump bump. We did have a thump for a little bit. It did pull back, and then we have been grinding higher, and we're into that seasonally strong period. November, we crushed it, right? It was the best month return in SPY, 4.7%. We also had seasonality of strength already in the cards for, election years. We run up into basically January 20th inauguration, despite the risks, geopolitical war vibes, et cetera, they are still not stopping the train that is option flow. And that particular chart kind of shows that we're still very much in the grip of higher without a macro trigger to interrupt, even if we do have some shake and bake. And by the way, the only shake and bake that I have seen, because remember I have VIX 1240 still on my bingo card before the next bout of volatility. The only intraday selling of small size under the surface has been in NYSE or small caps. So it's not showing up, right? Because FANG is barreling forward, but that is a mini air pocket of risk that I can see in the Russell rolling over and dampening the effect of SPY and Q right now into end of week, which we have obviously a big economic data point, which is non-farm payrolls. So if we do have a surprise weakness, I'm not expecting a big surprise, but then that could also cause some kind of gyrations and a little bit of a reversion to the mean for some of this advance. But for right now, it's firmly in play.
And it's a little bit of a game of hopscotch we're seeing lately. You sort of see that broader market going, and then the mag sort of sat around, and I kind of thought they'd sit around a little bit longer, but boy, they kind of took the baton, and the rest of the market went, okay, we'll sort of sit on the sidelines here. We did see financials kind of, I've been watching Goldman sort of a little bit sort of capped lately, not really running with things. So maybe there's a little bit of caution there ahead of NFP. I mean, we're kind of in that sweet spot. You often talk about that sort of the 10-year, not getting too high. We're back into that 420, 422 range last I looked. And for me, that always kind of says the porridge is warm. And that's kind of how that's kind of how the market likes things. It doesn't want things too crazy one way or the other. We saw a revision. So that's maybe a little bit
what?
A revision in jobs. What was the revision this morning?
Okay.
And so maybe that's a little bit
Jobless claims.
dovish.
Jobless claims and continuous claims are more impactful, and non-farm payrolls are more impactful. But I get your point. We still have the stickiness of an economic backdrop where they're spending, they're flying, their GDP is growing, the fiscal deficit is still huge. But all of that will potentially become unwound next year after that transition. And that's part of the question that's being asked right now. But we'll go to the next year after we kind of finish this particular year. But he does ask a very salient point, which is, when do you protect, right? Especially if you're worried about the uncertainties. And you've just mentioned a little bit of correction. I call it reversion, but it's a soft kind of air pocket of risk. It's not the air pocket that can be created by new policies, by escalation of war, big reasons. So far, we're in the throes of this year-end seasonality of size. So we kind of got to go with it and not fight it. But his point is good. How do you protect?
Well, it's insane. I mean, if you don't believe in this run, you're really battling. What was it? U.S. equity saw a whopping 141 billion of inflows, the largest monthly record inflow on record. Just massive inflows. I kind of joked today when I saw that. I said, oh, well, there's that big recession again. People have tons of money to put in the market. There's no recession. It's not happening. I mean, maybe it happens at some point, but right now you just have too many positive things, strong GDP. You just sort of have and I think Powell wants to cut rates. I think rates will come down. Maybe not insanely low as markets previously thought, but I think that's going to kind of bolster things as well, especially for the broadening and for small and mid mid caps and things like that. So for me, it kind of continues to be a little bit of Goldilocks. But do we stick our heads in the sand? No, we don't. We, as I always like to say, you kind of bet on the punch bowl, but then you hedge yourself for when things get a little too rowdy in the party and people start throwing TVs out the window like you're a 1970s rock band. And so you kind of want to hedge against when the market does throw a little bit tiff. I think we could get that one big day where all the bears go, okay, this is the beginning of a bit of a sell-off, and then that'll be it. So I think we could get maybe a 1 plus a morning sell-off. I mean, that's starting to get a little granular in terms of predictions. But over the next couple of weeks, I'm not really feeling like we're going to pull back very much at all. But now that we have volatility coming down, you have the opportunity. I don't think you have to look as much for things like butterflies. I think vol's getting cheap. So you can actually start to go out and look at just maybe simple put spreads. You could do like a 60, 50, 5,900 sort of put spread in, say, February, March, just create a little bit of downside protection for your portfolio. VIX, I agree with you. I think we drift a little bit lower still. I like that kind of 12.5 target. We have some long 15 puts that are doing very well, and a butterfly. I covered some of my short because the butterfly is generally long, then short 2 in the middle, then long another one further away in terms of puts or calls. And I covered one put because I'm a little nervous. We actually do start to go towards that 1250 level, maybe even lower by December expiry. So I want to take off a little bit of risk there and then just ride that put spread, which is along the 15 toward the 13, which is already done very, very well. It's starting to feel like you're getting a little bit greedy. Almost feels like that around the market as well. It kind of feels like every day you're like, oh, I'm going to strap on a couple more longs, take off a couple of here, add a couple more there. Things are getting a little on the thin side, but I think where you can kind of move the needle is you can say, well, look, I've got trimmed a lot of stock positions today, but what I plan on doing is adding some cheap convexity to the upside. So I'll sell out, took off an Amazon position today. We had another financed position short the 195 in January, long the 2010, 2020 for, I think, about even. And so took that off. But now I'm thinking maybe now that option prices have come in, you can start to look at maybe taking, if you've taken $10,000 off the table, you can maybe take 3,000 of that and look at some upside cheapy calls, because if things get going, there are a lot of cheapy kind of out of the money calls here if we do want to keep going parabolic. And so I think that's where the opportunity is. They're kind of crushing that upside. What's happening is, they're just, all the covered call funds are coming in. I was going to show you guys a chart of just how much AUM has come into this market. I mean, it is unbelievable. The whole option selling strategy game was around, I think there were about 4 billion in 2020, and we've got around 100 billion now. So this sort of option selling ETF game has gotten huge over the last 5 years. And that just keeps supplying markets. So you get weeks like this, all these covered call funds are coming in and just plastering market makers with calls, selling those calls, and that compresses vol. And then before you know it, you've got this kind of cheap, nice kind of risk reward to the upside. So you can take some risk off and maybe do a little bit of what we call stock replacement with your options. You can take off a position on $100 stock and maybe rebuy at like a 70 delta, let's say like a 70 call, and create similar upside, but with a lot less risk on the table. So this is where people start to kind of look at replacing some of the existing risks they have. I mean, if you're a long-term investor, you just kind of let your stocks run. But if you're a trader, not a bad time to take off some of that risk.
All right, this is something I show clients, and the reason I bring it up is because our market has been weighted so heavily to the Mag 7, the Magnificent 7. And you can see today that we had a very strong advance in the FANG stocks, or the SPX 7, however you want to call it, right? Amazon and blue skies, Apple and blue skies, NVIDIA coming up post earnings from 132 to 142, pushing up to 146. I mean, there is a movement in the large moat mega cap tech plays. So this happens to be a ratio of all of the 7 leading capital weighted stocks that make up the majority of the move in NASDAQ 100, which obviously moved very strongly today, right? So the reason I put this out is because the NASDAQ has actually moved almost 100% since the January 2023 low. And you can see as well this advance in the Mag 7 ratio, which back down here kind of formed this inverse head and shoulder for anyone who's kind of still into technical analysis. And literally, we really, from that low, the Qs are $1 away from being 100% over 2 years. So that is what you call outsized, incredible advance in 2 years. 100% in NASDAQ 100 in the last 2 years, we're $1 away. This is the Mag 7 ratio. You can still see this advance. You can still see when, banks had the backstop back in March of 2023, right? You can still see when we broke out in May of 2023. That's thanks to NVIDIA and the whole AI wave. You can see July, September, and October of 2023 before the Fed came in and Yellen came in, and what I affectionately call, because it is, the Fed pause and Yellen Yahtzee. Yellen Yahtzee is where she would issue shorter duration T-bills that adds liquidity to the system versus longer duration notes and bonds, which remove it as a way to help backstop the equity market. It's another form of policy intervention, long story short. So that obviously set free the bear above this prior, level of resistance was NVIDIA earnings. And then we had the big shake and bake, which was July. And you can see this trend line just so happens that it got exactly defended on August 5th, 2024, which was the after NASDAQ fell, 15%, SMH fell 25%, NVIDIA fell 35%, but it got strongly defended. So I still technically can chart this just like I do NASDAQ. My point is we've come all the way up for those who are fib analysis, or they're into potential fib analysis. We finally made it all the way up to this fib level. Now this was taken yesterday, but we're poking above it. This is a strong market. So the NASDAQ 100 is up literally 100% in 2 years. We have phenomenal FANG strength that hasn't even gone parabolic yet. It finally hit my price target. Like I'm literally waiting for this as a potential sign that we might get some shake and bake in this, exuberance. We haven't gotten it yet. We just hit it yesterday. And at the same time, speaking of growth, as I show to clients, and I know some people are not into intermarket analysis, but I love it. I love to use macro and intermarket and technical and quant and the whole thing. This is a growth value rotation tell for me. And one of the things that I mentioned is growth over value right now is in play. You can kind of see where this poked above my ratio of 2.05. That happened back here when we had a big push in May, happened to be NVIDIA earnings. And then the whole semi-complex moved higher with NASDAQ. And then we got absolutely above our skis. And this was July 10th. We got extended. And just like anything else, you got parabolas. In stocks, well, this was a parabola in an indicator that the growth value rotation had gone too far, too fast, and it came back in. We just poked above today. I've been waiting for this 2.05 to trigger for weeks and weeks and weeks. Now NVIDIA earnings out of the way, came down and settled really nicely at that 136. Really, we talked about that. I'm not worried about this rotation after NVIDIA earnings, and now it's back in play. So this is strength. So if we're going to have a trigger to interrupt, we're going to see this get right back down. We're going to see this get rejected. I know these are not your usual ways of telling the market strength, but I like them. I think they work really well. And that's all I wanted to say was that we basically still have a market that is doing its thing of running hot on the Mag 7 contingency of size. And now we need to see if we're going to get a broadening out of the market. But for right now, those are the two tells that I have. One is very strong, and the other one is up at resistance. So it's going to be it's going to be very interesting if we have any rejection here and come back down, which is not my baseline bet. More likely we push higher.
Could be that, and given that the next sort of 3 weeks to 4 weeks are somewhat positive from a lot of different angles, that sort of that break at the 205 level, really, in that sense, you could almost say that the mags have a little bit more room. Like you said, we're just kind of getting going potentially, and especially NVIDIA, it's held back a little bit since earnings. We've seen Amazon really go, Microsoft starting to recover, Apple making all-time highs. So we have some strength in other areas. Tesla started to act well again today, even though Musk may not get his money, but I have a feeling he will one way or another. Yeah. So so don't worry. he says he's not about the money, but if he doesn't get his 50 billion, he won't be happy. So yeah, I mean, it could be, and I mean, everybody's got to own Nvidia, right? It's a passive,
No,
it's a
well,
passive
we
thing.
can trade it. I don't, I know we have different time frames, but I'm just pointing out that whole strength right now, we're not talking about an intraday, right? I'm just saying big picture, this has been the train we've been on and it has not derailed. We need a macro trigger for it to become unwound. So that basically brings me back before we get into individual trades that you have profiled, that you've posted for clients using your particular flavor of, checking out volatility and then the structure of options tactically to kind of manifest that trade. And it's been working really well. And granted, we have a lot that's moving higher, from the Bitcoin, speculative assets to boring, even old tech, in other words, that had been really, really depressed, is coming back up. That SaaS reacceleration that we talked about the past few times has really worked out. The Twilios and the Docu and the Square and the Palantir. Oh my goodness, and names that you probably don't know, like CFLT and ESTC. So I'm excited that we still have this going, but of course, as good as it gets, sometimes creates this, I don't want to call it paranoia, but reason to slow down. And we're coming here going, yeah, we still see lots of strength, and most of this stuff is long. The only short I have identified this week is FedEx. It's very hard to add protection here, but long story short, I think after inauguration, market will look very, very different, and that really means mid-January. So make hay while the sun shines, but then let's start looking very seriously at the other side of a melt up, which is a meltdown after mid-January.
Yeah, and I think that's kind
maybe
of,
we don't mid-January. Maybe this goes all the way to March, but I still think mid-January is a good time to really start planning for protection.
well, remember last January, we kind of had that dip for a couple of days and everyone said, okay, that's it, because we had a very nice November, December. And then everyone thought, okay, maybe this is where we're going to pause. And then we just turned right back around and we kept going. But you're right, this next year won't be business as usual. We've got this big event. Sometimes the market kind of has this almost like a landmark. It's like it's just focused on getting to a certain point before it decides to change direction. So sometimes it needs a landmark, a reason. It doesn't have to necessarily be news. It can be just, okay, here's a big event. And then it just acts like a magnet, almost like that call or strike. It's like this magnet, and everyone just goes, okay, we're going to have tunnel vision until we get close to that, and then we'll have a little bit of a reason to maybe tack and change direction a little bit. So maybe that's what happens in January. And then, of course, we've talked about this sort of Trump honeymoon that, may wear off a little bit. So everyone kind of, saw that as kind of, terrific for stocks because of this and that and whatever. But there's the reality that sets in that maybe some of these things will be difficult to accomplish. And maybe some of the things aren't, as good as the headlines might lead us to believe. Like, okay, you're going to cut trillions of dollars in government spending. That may not be that great for a lot of people. So there's, the market will have a chance to kind of reframe some of these ideas that have been looked at very positively. So, I think, it's a good time to be careful. We have a question from somebody saying, are you going to be hedging? Absolutely. I'm going to be starting to look at hedges because we've come from sort of a VIX 20 to a VIX 12. That starts to make hedges a lot more reasonable.
Cheap.
And that's a time to...
And cheaper.
Exactly. They get cheaper, and sometimes that in itself can keep people invested, because if you own the market and you've got a whole bunch of insurance, you don't really have any reason to be necessarily nervous because you're protected, right? You've got your house insurance. You're not worried about your house. So that can kind of keep people convinced that stocks may continue to go up. So as traders, we might be in a different realm a little bit. But from a big picture standpoint, people are plowing a lot of money in this market, and cheap insurance makes it easier to keep doing that. In the meantime, we're going to look for opportunities because that's what we do. That is what we do. And so Target today, we saw this little push up into this. We had a nice push down to 120 after the earnings. We got up, and what I like to do sometimes is I like to set the price. I like the market to set the price for me. And so we got up to around 132, dipped, a little jump again. And so it seems to me like a little price has been set. And this is kind of a really good thing for viewers to think about when they're, either when you're trying to buy a stock that's plunging and you don't want to catch that falling knife, wait for things to kind of settle down a little bit, consolidate a bit, give you an idea that the move has sort of simmered out a little bit. And so here you've got this gap that they closed and it's bouncing its head off there. So what I did was I went in and I said, okay, what can I get here? I want to keep this short term. I don't want to carry anything of this nature into January necessarily, because that sort of whole changing of the clock, the year, sometimes, brings an about face in markets. So right now, I still believe that there's going to be a bit of an overhang based on the results that Target put out. And so I went in and I sold the 130, 135 call spread. So this is a bear call spread, right? Because you're selling the 130 call, buying the 135, and I think I got about $1.70 or something for it today. So $1.70 to potentially the max drawdown on that is going to be 330. So you're sort of trying to make $1.70. Worst case scenario, you lose 330. But I'm thinking that this is going to burn off a little bit. Now, I'm not doing it necessarily for volatility reasons, right? I'm not selling this volatility, this option pricing, because I think it's extremely expensive. It's a little bit more of a play on, okay, I think things can continue to calm down in volatility in general. And this is a stock that I can sort of stick my flag in the sand and go, okay, I think I'd like a little bit of a few negative positions in here, as opposed to just kind of having, being all in on sort of long everything else. So, and I've got plenty of other stuff going on. So MSTR, so I thought that was kind of cool. I might look for a couple things like that. McDonald's is another one. I keep seeing that 300 call wall really hold up. And I said I didn't do anything about it. I hate it when I do this. But earlier, we were down in the 285 range. And I said, if we can get back to 300, I even had my alert set up. If we can get back to 300, I'm going to go short this thing because volatility is actually kind of cheap. The options are kind of cheap at that point. And I just got busy. I didn't do it, but we pulled back to 290. And this is another name that maybe is going to need a little bit more time to sort itself out. I like names like that, where I kind of go, you know what? Of course, McDonald's is going to figure it out at some point. I'm not saying be negative on McDonald's for the next year. But sometimes as options traders, you got to just kind of go, okay, for the next 3 weeks, can I claim reasonably with reasonable confidence that I think, things are going to continue as they are. And I think that's a reasonable thing to expect from that stock. And the whole kind of fast food area, as we know, because of RFK Jr., is sort of neither here nor there. Shack, we did really well on some Shack calls. So here's an example of, people always ask me, well, what are your rules for buying options? Well, on the one hand, I like to buy calls once a horse is out of the barn, because I've got a tailwind at that point, right? I'm not a big fan of buying options into a strong falling market. Who am I to think that I'm going to be right when the market's telling me that's the wrong thing to do at this point? So I like to wait, look, I'm going to miss the bottom. I'm going to always miss the bottom almost. But once it starts going in the right direction again, that's kind of a good time to jump on. So I jumped on some Shake Shack calls in here. We made about 65% on them as we got back to this old high here. And I think, and of course, behind that idea, there should be a little bit of a storyline, right? You don't just do this on some stock that's popped up on your screen. You have no idea about it. I think this is a great company in expansion mode. I probably wouldn't eat there very much, but I think they're doing some of the right things in an area that's been challenged a little bit. We've seen a lot of softness in the fast food space. And this is one of those names that is kind of bucking the trend. So jumped on those, and that's kind of a good way to sort of look at things. Try to have as many of those tailwinds in your favor. Don't try to bet against something that's happening, that catch that falling knife. Who knows when it's going to turn around? You're going to end up buying calls and then buying calls. That's I always like to say, catching a falling knife, it's not that great, because you're catching it here and then you're catching it there and then you're catching it there. And then you end up with a nice average price, much, much higher. And you need a significant rally at that point just to kind of get back to even. Now, MSTR, I thought was an interesting one. We had just huge volatility in this particular name. MSTR was after, the whole Bitcoin complex went bananas, right? We all know the MSTR went to 550. then it pulled back quite strongly, almost $200 in fact. But the implied volatility got to around 220, 230, which is very, very high. And at that time I said, an iron condor on this would be great. And it would have been. I didn't do it, but the spreads were terrible on this name, which is kind of expected on a $450 stock that's moving insanely. The market makers are just going, don't really want to play. So if you really, really want to play, then I'm going to charge you through the nose. So they give you these nasty spreads. But we've come down since then. We come down from 220 and we got down to about, it really jumped today actually. We got down to, when I looked earlier in the day and MSTR was around 370, 375, the implied volatility was around 115, 117. And look at the jump we had just this afternoon. I don't know, I heard somebody maybe saying Sailor might be finished selling for now, or I'm not sure if there was actually any news, but Coinbase was kind of leading the way last couple of days, and MSTR had this overhang and it finally snapped out of it and bounced back. So the stock ran up. Interestingly enough, the stock ran up about $40, $30, let's say. And the implied volatility, the at the money, ran up about, what is that? About 15 vol points, even a little bit more, maybe 17 vol points. So that bounced very nicely. And that's a bit unusual, right? You're not going to see Microsoft do that. If Microsoft rallies, the vol isn't going to jump significantly. But in this space, you tend to get that happening. So if we get follow through on MSTR to the upside, you're probably going to see it move up into the 150 range, 160 range. And then if you own MSTR, that's probably not a bad time to start considering maybe some covered calls against it. I mean, this is not a stock that I would own personally as a long-term investment, but I'm not, there are people out there who've done much better on the Bitcoin complex than I have, and congrats to them. But if it is something you really, really want to hold, once that vol gets up into sort of the 150, 160 range, I think it starts to look a little bit interesting in terms of being able to harvest some of that very, very high premium that people are paying for. And that's kind of the mode that we're in right now, right? So I mean, this is a bit unusual, but we're in this mode with VIX 12 where there's not a lot of excitement in the option space. It's a little bit lean. You're not getting very much for your put sales, your covered calls, and a lot of the benefit is becoming theta. So we kind of got a little bit spoiled there in September, August. I don't know if we were spoiled in August with that sell-off, but we got spoiled from a volatility perspective. We had this nice juicy VIX and there were lots of opportunities and there was a little bit of movement. And so you could sort of, we played the vol crush in, 5 or 6 different ways. That was really fun. Now you're back to this kind of boring paint dry kind of market where you're just kind of waiting for that theta decay, that sort of boring, you're letting time do the work for you, but there's no way to speed up time. It is what it is. You got to wait another day for a little more theta to come your way. And so that's the reality of this market. So what you really want to do is to go out and look very carefully. This is when, when everything's nuts, there's opportunity everywhere. But now we have to be a little bit more careful with charts being very extended. You got to be a little bit more careful selling those cash secured puts because, it's not going to take much for the market to kind of pull back 70 points. And for your positions to be underwater. Now with covered calls, you take an example like Walmart. If we're looking around for opportunity, look at the skew. So you can use something like this to take a look at the skew levels. So here, when this chart, which measures 25 delta puts versus 25 delta calls. So it's basically saying, look, are puts more expensive than calls? How much? Are calls more expensive than puts? This gives you a really nice pictorial of how that looks. And so anything above this 0 line means puts are more expensive than calls. And anything below the 0 line means calls are more expensive than puts. And when calls are more expensive than puts, as they are here, this is the first time in about a year where we've had this sort of more expensive calls on a name like Walmart, which is a little bit weird. But if you are lucky and you've owned Walmart over some time, it's done very, very well, despite the fact that it's a stock maybe that should do better in a recession or, but I think they've done a lot of the right things, right? They're clearly mowing Target's lawn. They've grabbed all that kind of middle class kind of spending. So they're really, really doing well. Online business. Their pickup process, like they've really nailed it. So that's a stock that's done well. But if you want to maybe, if you're going to if you want to sort of say, listen, I think it's had a nice run, maybe I'd like to grab a little bit of premium here. And as people who know me know that I always say, listen, if vol levels are really, really, really low and skew particularly low, meaning that upper call skew just really pushed down, it's not really worth it, right? If I'm not getting compensated to give away my stock, which is what you're doing with a covered call, you're obligated to give your stock away if it goes through the strike price. If I'm not really getting compensated for that, then I'm not really interested. And I think that's being a good option trader, but being a good volatility seller, being a good covered call seller is really being able to go, yeah, you know what? That's not good enough for me. You can keep it. You can keep those calls. And I'm just going to stay long the stock, or I'm going to look at a different kind of structure that maybe makes a little bit more sense for me. And in a VIX 12 market, a lot of the time, I'm that guy who goes, I'm not impressed. Don't, you know, you're not going to entice me with your little itsy bitsy premiums. I don't want to take that chance. And that's been the right thing to do. As we see every day, the market just keeps going, going, going. So, and I'm starting to hear more complaints from people. I keep getting called away. Sometimes you got to just sit back and go, all right, let's see what the market gives us to the upside. And if there's a little nervousness that creeps back in and we pull back to 6,000 and we get a 14 VIX, 15 VIX, 16 VIX again, then we're sort of being paid. Now we're being presented with something that makes a little bit more sense from an options seller standpoint. So here on Walmart, you got this call skew that's a little bit more expensive. So what does that do? Well, what we can do is we can go in to the Walmart chain. Look at this move that Walmart has had. Just beautiful, beautiful, beautiful. I think it had a stock split in here at some point.
Market is also rewarding those with a big moat. So this is actually Costco and Walmart are part of that concentration risk. If we were to expand it to the MAG 10, MAG 20, they would make the list. Like Eli Lilly was part of the concentration list. In other words, it just has a very large following for a time, and then it goes into distribution. Like Walmart probably will around 100, right? If 80, then 100 has been my mantra. But still, Costco and Walmart are behaving as the best of breed in their particular space versus many others. And it's tough to get traction, very much like the MAG 7 or the SPY 7 versus SPY 493. So they're really, the money is just concentrated into the ones with the largest companies with the largest moat, not really fair value, giving them too much credit, but it's happening. It's definitely happening. So you are at this point where how are you protecting, or are you trying to just kind of collect some income on Walmart? What's your strategy in particular for?
Just to collect a little bit of income, because I look at Walmart and I go, that PE is awfully close to an Amazon PE, for example, which I said a couple of weeks ago. And Amazon's kept going, and I still love Amazon. I mean, for me, Walmart is the past. They're doing things in the present very well. Amazon is the present and future. They've redefined everything, logistics, everything. So if I compare those two names and I go, these stocks are kind of, and maybe it's changed a little bit this week with Amazon's run. I mean, it's run up 10% in a week. Yeah. So,
but that's not really the market doing anything other than speculating with a lot of liquidity and a lot of gains, number one. Number two, the dollar losing value relative to things, and of course, money finding its way because of the value of the dollar falling relative to the stock market. It makes it look bigger than it is. We're kind of in this crack up boom phase when it comes to classical economics, which is really indicative of risk isn't seen. So that is great to trade in the short term, but when it does turn, and it will, it's not really, in other words, we can't defend it fundamentally anymore because the money will start to leave. Money's looking for a home. There's just so much of it. So but it isn't, unfortunately, it's not equally distributed. Just like our economy, it's not equally distributed. So those who have the wealth are holding it, and they're benefiting from inflation, benefiting from a falling dollar, benefiting from this crack up boom phase. But unfortunately, it will find its day where it says, okay, we're done, and contracts. And I think that's kind of the interesting question that he's asking, or he or she is asking in Anonymous, going, hey, what about protection? Because this is getting a little silly, right? The PE levels and such. So what you're doing is trying to extract some income out of these high flyers that are relatively safe and, really this lacks volatility relative to a biotech or some other plays that are thinly traded. This is not thinly traded. This is very, very strong sponsorship. And again, a lot of money is hiding out in concentration risk, which is also Walmart. But I do want to spend a moment, I know you finish your strategy, but I want to spend a moment talking about the macro risks, because I think that would answer the question more directly, which I have written about and thought about a lot, right? So make hay while the sun shines. But then we do actually.
I think there are ways. I mean, pretty simple ways that you can protect. I mean, I love the good old collar. I think you can sort of, especially in a name like this where the calls are a little bit more expensive, then that really starts to price well, because you're selling something expensive and you're buying a put that's a little bit cheaper. So that's nice when it happens. It doesn't always happen that way, because typically your collar, well, that's where it kind of prices nicely. The market is saying, hey, here, do a collar, because this sort of makes sense. Oftentimes collars are not, they're great, and I'll still do them even if they're not vol positive, we call it, right? I may be selling something a little bit cheaper to buy something a little bit more expensive, but it works for me because it accomplishes something very defined, right? I know that I'm going to sell a call at the 110 level, and I'm going to have my stock called away there, but I'm going to use some of that to buy some downside protection. And so I'm going to have a very defined area where I know exactly what's going to happen. And it isn't kind of in the ether, right? You have specific strikes for that specific underlying. Whereas, if I buy VIX calls as protection for my overall portfolio, well, we don't know exactly what the VIX is going to do, right? The VIX isn't necessarily, a VIX 25 doesn't necessarily equate to 5,800 on the S&P. There isn't that direct correlation necessarily. We know that they have a relationship, but VIX is more about sentiment and fear and greed and all that stuff than it is about a specific level in the market. So oftentimes people will ask me, well, should I protect myself in the VIX or should I protect myself in S&P? Well, and this is the spiel I give them. I say, listen, this is what you have to think about. The VIX may or may not, we've had years where the VIX did not react all that impressively to sell-offs. And so that can happen. And then we've had more recent times where you and I have talked about this extremely high beta of the VIX to a move in the S&P. And you really are getting that juice and beta out of the VIX. So it has been an okay place to be. So those are sort of the questions you want to ask yourself when you're considering S&P versus the VIX. But for just broader downside protection, this is where you sort of go, well, okay. And you and I have talked about downside butterflies in the QQQ, which can maybe make a little bit of sense. Now with volatility cheap, you don't necessarily have to look for that kind of structure. You can just do something a little bit more simple, for lack of a better word, and just kind of buy a put and sell a further out of the money put. And it really doesn't have to be much more complex than that. I'd love to give you something more complex, but sometimes simple is, keep it simple, stupid is the kind of way to go. And you look at the QQQ at 523 and you could pick up like a 500 put for 369 and maybe sell some 465s for 115 out to January. So if you're worried about leading up to the inauguration, this won't quite capture the actual inauguration. So you might have to go out a little bit further. But if you're worried about sort of this crazy parabolic kind of market and all these stocks that are going parabolic, this is not too bad a way to kind of protect some of your downside. Now, it's all, one thing I tell people about protection is it's not always that easy to protect. Like I could show you a strategy that will give you pretty good protection, but only if the market really starts to crater. To get absolute perfect protection that's going to give you that instant protection if we go down is very difficult to do without paying a lot of money for it. If you're really nervous as a trader, as an investor, you might have a portfolio where, look, you're long Walmart and you're long Amazon and you're long J&J and you just need something to get you through an event that might become catastrophic. So you can kind of create a spread like this to help you out. As a trader, you might just say, you know what, I'm getting a little bit nervous. I told a couple of people, listen, I don't think it's, don't keep feeling this FOMO. I mean, I think it could keep going for a couple of weeks. It's okay to miss out, right? And I see people, in the
That's
chat
very
kind of
hard for
going,
people to, yes, I know.
people go,
Hard
oh,
for them
I
to
feel like
do.
I'm missing everything, right? How often do you hear that, Samantha? I feel like I'm
Oh
missing
no,
everything.
this is ubiquitous. But
Yeah.
getting to that, I mean, because I did a post, right, from 666 to 6666, which is basically that big overarching bottom of March 2009 to Bank of America out with a price target for 2025 of 6666. Of course, they're being cheeky, and we're at, let's call it 6066. So we get 600 points to go. Now, we could keep going, right? But that's the crack up boom that I'm talking about, that I've written about. And it completely does not price in things that I'm worried about and others are looking at, which is what follows a melt up is a meltdown. What about war? And this isn't just skirmishes, or this isn't just isolated countries like Ukraine and Russia that have been at it for 2 years. This is escalation into nuclear, this and surprise bans of uranium and bans of rare earths from China to the US, which we're 100% dependent on. And this is widening out of regional conflicts and escalation of those conflicts into the world. So that's the backdrop that the market's not pricing in. The market doesn't price in what it can't, feel, and it also doesn't know how to adjust earnings based on that. And in the meantime, we're still in the firm grip and control of an options market that is clearly bid and moving the underlying, and it's largely concentrated in the largest companies that have also leveraged ETFs, right? Like the MSTRs and the NVIDIAs of the world, where we don't even need as much margin anymore because we're using options, we're using these surrogates, right? Like these leveraged ETFs. In fact, ETFs are everywhere now. And there's just plenty of liquidity. But the war is a concern. Tariffs are not priced in. How the administration is going to kind of thread that needle between getting tariffs implemented. And I found a really ironic how they love Besant, the new US Treasury Secretary that will come in, who said tariffs can't be inflationary because of the price of one thing goes up unless you give people more money, then they have less money to spend on the other thing, so there's no inflation. Sorry, but Jeffrey nailed it. Jeffrey Fouvre, who is our classical economics, he said, Besant saying tariffs reduce inflation is like saying, look, you are poorer, so you have less inflation. So the point is that how they're going to thread the needle of implementing, rolling out these policies around tariffs, around fiscal restructuring. Oh my goodness, we don't know. We've not been here before, in addition to war not being priced in. So I think that people have a reason to be worried, because I am still focused on the fact that we have a falling dollar value, even if the DXY price right now is strong relative to peers. That's because those are politically driven devaluations in the yen and the euro and the like. So it's not apparent to many that the reason these stocks are rising is because the value of the dollar is falling. It's not apparent that these policies that look so wonderful on the honeymoon period may actually not get implemented or not be implemented smoothly, and they cause constriction and contraction in the government, which is good. We need it, but it's short-term pain, and that's not being priced in. The market it's ignoring everything that comes out on the news, on the war front. So that's the worry part. It's not reasonable. So when we start to have it's not a natural reaction. So
structurally too. So I mean, those are all great reasons to have kind of eyes in the back of your head, but structurally as well. You mentioned that sort of elevated, the leveraged AUM. This is one version here: derivatives income fund AUM growth. just really, really massive. I have another chart somewhere showing the leverage products specifically. I mean, they have really exploded, and all that is, we talked about gamma earlier. All that is more, more fodder for a downdraft again. So don't think that an August 5th can't happen again. It doesn't necessarily have to be any particular thing. It usually starts with something like Japanese yen trade, yen carry trade, that kind of gets things going. But the structure of the market, the way that volatility has become bigger than life, and there's almost these embedded potholes below the surface. And we showed a bit of the gamma earlier. You get into certain pockets of the market, price wise, and there could just could be like a trap door. And August 5th was exactly one of those, just a trap door.
And that was
So there's
also a
always that
convexity,
risk.
and it was also a convexity trade that once we had fallen 15% in 4 weeks in NASDAQ, it hit a particular level, just happened to be 96 on the video, which was major support, but we also hit 65 on VIX, and it triggered, right, the shorts to come in, boom, and a convexity rally of short covering followed aggressively, like unprecedented. So sometimes we have those types of reactions. Sometimes we have policy intervention, Fed and Treasury, and the like. Oftentimes it's stuff that's much more complicated from a macro standpoint of yield differentials with Japan and the like, dollar falling, etc. But for right now, we are in a crack up boom phase. We are in a structurally option, specific bullish flow phase where the macro triggers have not come in to show the market that we actually need to price out rate cuts, because right now they're still priced in. 25 is still expected, 74% chance for the December 18th meeting. Bank of Japan is threatening a hike, but I don't think it's going to come this year. That's a 50% chance. Anyway, we definitely have not gotten the triggers yet on the macro front of economic weakness from a spiking higher unemployment rate. But when they do come together, when the yen carry trade starts to unwind again into rising jobless claims above 267,000, continuous claims have already been trending higher. When we start to get bad economic data on top of falling oil, falling yields, rising yen, then we will start to get more de-risking than we had from July 10th into August 5th. It'll be faster because the muscle memory of the market will remember, oh, we fell 15% like that. Let's go 25 this time. That's what the market will not allow folks to come in and get that protection when they don't need it.
Buy a little insurance before the roof is burning, right? And that's
correct.
And that's kind of what you got to do. So I mean, you could.
But it might be a hedge that doesn't pay, and that's the risk. But it's better than having a completely complacent, fully. I'm just saying, I agree with you. I'm bullish until mid-January, maybe even March, but I absolutely do not see this rate of change in the market advance at all sustainable for next year. I am not buying my 7,500 SPX hat. I'm not even buying a 7,000 SPX hat. I think it's actually going to be treacherous, but we're not there yet.
Well, it could be, and you know what? It'll be kind of an interesting trader's market again at that point. We can kind of just throw out a little idea there for people who just kind of want to have that sort of little bit of insurance in their back pocket. What I like to do is I like to give myself some time, so sort of minimum 10, 12 months. So you could go out to say a January 2026 and pick up sort of a 520, 515. That's going to get you, what is that, roughly 15% out of the money. And now with the whole curve coming in, right, that volatility curve coming in, it's a little bit more reasonable now, right? That the 1 year doesn't move as much as the near term the option pricing does, but it's come in a little bit. And so you can pick up for about $12, you can get a 515 put, which is, what is that, maybe 2% of where the S&P is trading right now. So for about 2%, you get a year. And what I really like about that, some people try to focus on buying protection in the near term. What you don't get as much in the near term And I don't like to do callers at the 1 year level, right? You're not gonna find me doing a caller out to Jan 2026. So callers I think are okay for something shorter term, get you through a little bit of a period. One of my favorite ways to trade a caller is kind of do like a 6 month with a 3 month roll. So do 6 months, after 3 months, you roll it again, and you just kind of keep that going forward. But if you just want to kind of have a set it and forget it, little bit of premium, what you really want that you don't get with a 1 month option very much is that Vega exposure. So we can talk about all the options, Greeks, the deltas, the gammas, the Vegas, of course, but the Vega is the big one when you have protection, because when the market comes off, you're going to make money from delta, which means the direction of the market should make your put go up. That's the relationship we understand. What you're also going to get is this exposure to Vega. So what happens is when people are starting to panic, and as they did in July, August, and September as well, is they started to panic and start to pile into those protective options. And what that does is it pushes up implied volatility. So you're going to benefit in two ways: from direction, because your put should go up when the market goes down, but also from an increase in the tendency for people to keep paying up for these things. So you get to benefit a couple of different ways. You're not going to get that from a 2 week option or a 1 week option, not even very much from a 1 month option. So, and you don't have to worry about it very much, right? You buy a 1 month option, you get to see your money disappear, and then you have to do it again. And so a 1 year is kind of a nice way to go about it. And that's going to be your little piece. On another August 5th, you're going to have something in your pocket. Sure, you might be getting hurt on some of your stocks, but you're going to have a piece that is going to explode in value.
What is this? What are the strikes again? Just to review that, since it's hard to see, very, very small font.
Oh, it is. Oh, okay. Yeah, it's a 515 strike in January out to January 2026. So with the market now at 607, pick up the 515 around $12 to see where they are tomorrow. But that might not be a bad little way to kind of get a little bit of exposure. And any members.
So you just have a directional put, or do you have a put spread? Or are you on a condor? I'm trying
just a directional put. Just directional at this point. You can cut down a little bit, and that's a good point. Some people will want to spread it out and just go, you know what? I don't need to protect the SPY going to 400 because that's probably not going to happen. So they'll spread it out and cut back a little bit on that cost. But what happens in a very, very low VIX environment, particularly if we stay there for another 3 weeks, a month, is outright purchases become okay again. You don't have to spread things as much. In a higher vol environment or mid-vol environment, you kind of have to spread things because everything's gotten so expensive. So you need a way to alleviate some of that cost.
All right. Well, we'll leave it there because we went a little over that power hour, but we're very glad that you joined, and hopefully this is something you will come back and attend again on Wednesday after the market close, 4 o'clock. We'll do another one with Hans, and then basically ask your questions. Come on in with comments, questions. We're getting closer to the end of the year. We'll be through non-farm payroll. We'll be right before the Fed, the FOMC date, which is the 18th, Bank of Japan on the 19th, and then just basically bringing it to a close and trying to navigate the end of year, which could trigger some profit taking at the beginning of January, like it did last year. We'll see. But right now, we definitely have debt ceiling, January 6th election confirmation. There are some reasons that and the 20th inauguration. There are definitely some reasons why we could get some gyrations here. But big picture, make hay while the sun shines, and we'll try to alert you when it stops, or at least looks a little cloudy. And on that note, thank you so much, Hans. Thank you, everyone, for joining. And we wish you a great rest of the trading week. Bye-bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.